Hello and good morning. Welcome to the Mining Show, brought to you by Blytheway on Core Finance. I'm Charlie Gibson. Now, as we all know, in the world of mining, one of the holy grails is that very elusive corporate deal where either somebody buys something or somebody sells something. Well, one of the companies which has just pulled off this particular trick is Serabi, listed here in London, and they have entered into a deal to buy Coringa for, well, in total it's 22 million US dollars. They've also just had their third quarter results. They showed a return to profitability, and joining me now is the Chief Executive Officer of Serabi, Mike Hodgson. Mike, very good morning. Thank you very much indeed for joining us.
Thank you.
So, tell us about the deal. I think what everyone wants to know about is this corporate deal, the deal to buy Coringa. Just describe the asset and how it came about that you're now buying it.
Okay, well, it's something which we've known about for a long time. It's only 200 kilometers from Palito, which sounds a lot, but in Brazil terms, it's nothing. It's next door. And we're joined by a paved road almost between the two, so access between the two is very good. There's a town of about 100,000 people between the two assets as well. So it's always been on our radar because it makes complete sense to us as a satellite operation. It's a very similar deposit to Palito. It's a vein, underground, high-grade vein deposit. It's got about 400,000 ounces of gold, so it's a very similar size to Palito. And Anfield, who are the vendor, just did a bankable feasibility study which shows it's going to produce something about 32,000 ounces per year, out from reserves only for the next 5 years, with a very good resource tail after that for future reserve resource conversion. So we see it as a long-lived asset. I think Anfield, when they bought it, they thought it was going to be a much bigger deposit to build a platform, a gold mining company in Brazil. And I think in the end they've come to the conclusion, which we basically always thought it was smaller than that, but a great bolt-on for us, but not really the big company they thought it was, big asset it was going to be for them. So really works for us. I think we can leverage off our production already. We've got 40,000 ounces of high-grade gold production in Brazil. We've got the same mining method. We'll apply the same approach. We'll put it into production. We'll get it permitted, and it will just be a replication of what we've already done. So for investors, it's a pretty low-risk proposition. We're not suddenly leaping into the unknown and doing something we've never done before. This is a carbon copy deposit of what we've done. It's in exactly the same area. It's neighboring. We're going to deal with the same authorities that we already have a great relationship with in Brazil, the DMPM and the environmental agencies, etc. So, I think we're really well placed. Well, we are best placed to do something and get this asset into production. It's going to move us from 40,000 ounces to 70, nearly 80,000 ounces. I think we tag on some organic growth, which we're doing at Palito now, some step-out drilling, surface drilling as well. It can be really a very good 2 years for us. And as I said, we're producing 40,000 ounces with a margin of about $200 to $300 an ounce. I really think bringing in this Coringa, we can share a lot of the managerial synergy, the administration synergy, so we can probably get our all-in sustaining costs cut by about $100. So if we're suddenly doing 70, 80,000 ounces a year with a margin of, say, 300, 350, people can do the maths and see the sort of cash flow we're going to throw off. So it's not a transformative deal, but it's a great business decision.
It's almost transformative. I mean, it's sort of you're hinting here that it's going to double your size, more or less.
It will, yes. I mean, it doesn't get you into the magical 100,000 ounces and with the big boys, but it makes it a very nice junior company.
It probably gets you out of the small bracket anyway.
Yes, I think we suffer this. Someone said this to me the other day, and I think it's a great description. We're too small to be big, and we're too big to be small, and it improves that a little bit.
So it gets you out of the medium size,
yes,
the falling between two stools category.
Exactly, yes.
Let me ask you about the price. 22 million US dollars, not all up front. It's 5 and 5 and 12, I think.
Correct, yes.
And you're buying about 300,000 ounces, so ish, $66 an ounce.
That's right. Yep.
How does that compare to your rating currently? And is that accretive? Is that dilutive?
Well, we believe it's accretive, certainly. We bought the Sao Chico asset at probably about 3 years ago, and that's probably near $100 an ounce, and that's worked out to be a really terrific little deposit. And we bought it with 100,000 ounces. We mined out about 50,000 ounces, and now it's 120,000 ounces. We're growing it all the time. Coringa's got terrific upside. It's a 4-kilometer long strike length old Garimpo, which is an artisanal mine. Literally, Anfield only drilled on 2 parts of it. There was an earlier resource on it of nearly 1 million ounces, which got cut back by Coringa because they're a bit more penal on their resource classification. For the want of a fairly modest drill program, I think you can bring a lot of those ounces back in. I'm not hung up on the 400,000 ounces that's in the mine plan and in the reserves today. I think, like Palito, it'll be a long-lived asset, and as long as you don't chase scale and go crazy in your mining rate, it'll serve you well and be a long-lived asset. So I think so. Those metrics like how many dollars per resource ounce, reserve ounce, which is what you just quoted, is I think a little bit misleading, because I think at the end of the day, it's a vein mine which, as long as it's run correctly, will serve well and serve a long time.
So it could be one of those where you always have 10 years of resource or reserve life ahead
Well, I
of
worked
you.
at South Crofty for many years, and I live in Cornwall still, and that was a 3-year mine life and ran for 200 years. So yes.
There you go. Hoping to do the same thing. You mentioned the Garampiros there.
Yes.
Are there any Garampiros?
No, they've pretty much all left town. I mean, generally when those guys get down to the hard rock and mine out the oxides, which is only 50 metres down, they just go and disappear, and there's always better or lower hanging fruit somewhere else. So once they get to the hard rock, they naturally disappear. So all that big intensive Garimpo mining occurred in sort of the 70s and the 80s. So really they're great explorers. They find you the oxide gold, and you just drill underneath it, and that's it. They don't find everything, but generally they certainly don't mine for fun. So once if they've been mining there, there's good gold.
Excellent. And what about the development plan? Because obviously to develop this, you're going to have to invest in it as well. How much do you think you're going to need to invest? You said Anfield had just done a bankable feasibility study?
They did a BFS in July this year, and they estimate a $28 million capital spend. I think we've got we've got that to fall back on, plus the fact we've just done almost the identical build at Palito in the last 3 years. And we
what out of curiosity was the MPV of the BFS?
Of the Enfield one. The bankable one, it was around $30 million, so very low. But again, it's just on a very small reserve, and I think NPVs on vein deposits, for the reason I just said, they're almost irrelevant. I don't see, because you never know what the mine life is.
Yeah.
The capex that Anfield have got is about $28 million. Now we have just. Well, 2 years ago, we completed Palito. We put Palito into production for $20 million. Same size deposit, 40,000 ounces, a little bit bigger. So we think we can shave that cost off. Not a lot, but I think solidly we think we can get about $5 million off that, and probably build it for a little over 20 million, 21, $22 million. Again, we would utilise our expertise in the region. We've been around there for a long time. We'd find a lot of second-hand equipment. Again, because we're already in production just up the road, we can leverage off a lot of the equipment we've got. And one thing I really want to look at is not necessarily producing gold at Coringa. We've got a gold plant at Palito. It's only 200 kilometres up the road. One thing we will look at is putting in, obviously, underground mine, front end of the plant, which is already at site. It's already bought there. It's there. Because in that capital cost, there is already, sorry, not in that capital cost, but actually at Coringa, they bought a plant already, which is just waiting to be built. So, but we might look at putting in crushing, grinding and flotation, and trucking a concentrate to Palito, which is up a paved road, 3 hours trucking away. It will be about 30 tonnes a day, not much, and putting it through our gold plant there. Big plus on that, no security at Coringa, no gold being produced there, so that's obviously a big issue in that part of Brazil. So we already have security at Palito, obviously, because we've got gold production. So not having to replicate that at Coringa is a big positive. And plus the fact you would have non-toxic tailings at Coringa as well. You'd be just throwing away inert tailings, so no cyanide down there. And these are big selling points to get started. I'm not saying we wouldn't produce physical gold at Coringa forever, but it would certainly be a fast start, and that would shave a lot off the capital cost as well. And I think it would expedite the environmental permitting as well.
Are the logistics infrastructure available there to put, what did you say, 30 tonnes a day of concentrate down the road?
We've got the capacity at Palito, or very easily you could have the capacity at Palito to handle that. Trucking 1 truck of concentrate a day is easy. The road's paved. All that's really needed infrastructurally wise at Coringa is an extension of the power line 15 kilometres inland to the site. That said, I mean, but that size operation could easily run on diesel generators anyway. So it would be, but that would be a fair. That's in that capital cost of about $20 million to bring in the power line.
So the $21 million, and then you got 22 million acquisition.
Yeah.
So that's 43-ish million. You got 10 million in the bank at the moment. So somewhere along the line in the next couple of years, because the last deferred payment is 2 years out, I think.
That's right.
So you're going to have to come up with $32-ish million.
Yes.
Thoughts on funding that?
Well, the nice thing about the deal at the moment is it's not the closing isn't depending on funding. We can fund that at Treasury, as you absolutely say. We've got 10, so we'll certainly fund the first 5, and that'll be done. And then we've got until the end of Q1 to decide how we do the rest. We're talking. We have a debt facility with Sprott Asset Lending out of Toronto. They've known us for a long time. We've certainly delivered on our payments and paid off the debt and taken a bit more and paid it off. So we have a great relationship with those guys. They're certainly considering we're talking to those guys. We'll see where the gold price is and what the cash flow is. We're generating positive cash, so we'll continue to. It'll be basically it'll be a combination of the three. We would, I think, down the track want to put some equity into this, of course. And I think initially the first 2 payments could be a strong part, could be debt and some cash flow and less equity. Obviously, you've just said like it's going to be $20 million to build it. We don't quite exactly know when that's going to be. I mean, we've got the build is going to take, we've got to get it fully permitted. I anticipate that will take about another 6 to 12 months to do. It could be faster, and that's the point when we'll need the bigger raise to do that. But I think the nice thing is we don't have to do it immediately. We can watch what the market's doing. We can see where the price is. Hopefully the investors will see this is a great deal and our price will tick up, and we'll take advantage of that at the time. And I'd like to say, we've got a brilliant major shareholder, but they have 55% of the company. And that's a legacy of when we put Palito into production back in 2013. They underwrote the financing to do that. $25 million we raised. They put in a good part of that. They didn't want to be below. They wanted to be below 30%, but we couldn't get them that low, so they wanted to be above 50 to have trading freedom. And we haven't done a raising since. So that's a legacy of back then. Obviously, that makes us quite a liquid company. They never wanted to be above 50%. So here's our opportunity to solve our capital structure of the company in a good way, and they want to remain involved. They're completely supportive, but they understand they would almost step aside and want to be diluted for the greater good. It's always hard to get that message across to shareholders to say they're not abandoning us at all. They're very, very involved, and they're super supportive, and they've never left us wanting for anything. But as I said, they ideally want to be in a more sensible position and down in and less controlling, so much better for general market perception.
They're supportive and they want to be diluted as well.
Correct.
And in your, I won't say in your wildest dreams, but 12 months, so end of 18 you're permitted. Construction time 1.5 years?
It took us a year at Palito, so yeah, same sort of time I would say. Yeah, so
end of 19, so you might see first production early 20?
Yeah, or even late. I think we might get some we might get the initial sort of development production, in 2019. But again, as I said, we could enjoy. I mean, I want to say, I mean, a fair few of the permits are already in place. I mean, the construction permit is actually granted. The environmental license permitted is granted. We're waiting now for a trial mining license, which has been the application's in. So, once that's in, it's build ready. So it could be a lot faster than that. So just being cautious.
All right. Mike, thank you very much indeed. We look forward to that. Come back, tell us how it's going on. We'll, always interested to hear how the project is developing. And when do you actually take control of the asset?
19th of December.
19th of December. All right, excellent. Just in time for Christmas. Good Christmas present for all of us, and we hope for the shareholders as well. Excellent, ladies and gentlemen. I'm afraid that's all we've got time for. My very great thanks to Mike Hodgson, the Chief Executive Officer of Serabi. That's all from me, Charlie Gibson. Until next week on the Mining Show, brought to you by Blytheway on Core Finance. We'll be looking at more mining opportunities, and until that time, you have a very capital day.